Good afternoon, everyone. Here's Frankfurt speaking. Very happy and pleased to have you here today on our webinar about the recent developments and hot topics related to IRB. And here today, we'll have one of my close colleagues with whom we have been informing the IRB universe or audience by and large in the last 6-7 years. So Luis Barbosa, he's a partner in PwC Portugal, PwC Europe, like myself. And there will be another colleague of us joining us on the topic of AI, Piotr Geraskin, again from our team here in Frankfurt, the Quant team in Frankfurt. We have a number of interesting topics that we like to walk you through and discuss with you. And please, if you have questions, feel free to use the chat board on the right edge, on the right lower edge of your screen, where you can put down your questions, which will eventually be addressed after about an hour. We have the plan to run the topics about an hour, and then we will have a half an hour Q&A session where we would like to address all your questions. First, we'd like to give you a general overview about the ECB, key topics of ECB, and how they addressed the issues in the recent past, and how would they want the industry to get ready for the changes driven by CRR3 or Basel IV. And then we also like to consider all other areas where recently they introduced some of their understanding or some of their preferences, as much as they have discussed all of this in the so-called roundtables. Roundtables have taken place last year in October and November on topics of AI and credit risk management. And they were quite detailed as such that they were discussing at operational level how certain models should be rather looking like and what components should be, how the components should be adjusted according to CRR3 requirements. As you might recall, the first version of the guideline has been released in the year 2017. And in that year, first time we had this standardized understanding about the requirements. And this has been revised and published on multiple occasions. The most recent, comprehensive update had been related to climate-related risk and the standardized default definition and counterparty credit risk, and the guideline, related to this topic have been published last year in February. In August, we received another plan, an update on the plans, and that in 2025, we might be receiving certain new guidelines, especially related to CF, but this might not necessarily be released by ECB, but rather by EBA, because EBA program will cover all the relevant changes related to CRR3. So the expectation that we have is that that banks will receive more detailed granular guidelines on model development specifically in the area of CCF and LGD in this year, in this coming months of this year. Last year in October, there was a machine learning related workshop, in a virtual one, and in November as well, a very detailed roundtable about the general credit risk chapter of the guideline, and where certain topics have been exchanged with the industry's leading institutions that have been invited. Mostly there were IRB institutions and notable banks across all the continent. Here, before we furthermore go into detail, we like to briefly update you on some key topics that has been generally discussed, and will be also go further down in detail what the roundtable has been really talking about. In the roundtable, they've been talking about. On the general topics, what needs to be understood is that very clearly that the material climate and environmental risk factors should be seen as in the future or even today as part of the Pillar 1 models. Pillar 1 related to risk-weighted asset calculation, which is the capital, how we calculate and estimate the capital requirements. That can be as well used as a kind of override, but generally speaking, if the factors are somehow routinely presenting a statistical significance, they should be part and parcel of IRB models. Most of the industry right now is trying to prove that these factors are for the observation period when the financial creditors related information or non-financial information has been collected about the transactions and facilities, and that they're not significant, just to prove that they don't need necessarily to be part of the model. That's actually maybe a recipe that might work well in the short term, but in the long term, most certainly some banks will start collecting more data, will be using longer observation periods, and maybe finding out as well some level of statistical significance. And when the moment they start becoming a factor set, part of the factor set, the climate and environmental risk drivers, then in that case, I think the whole industry might need to look into this as a serious challenge. For many banks, it's a big deal because they have been just completing their IRB repair programs, and they now don't want necessarily to start statistically optimizing their models by adding the climate and environmental risk factors. So for that reason, trying to prove that they are insignificant might be a short-term solution, but definitely not in the long term. It might be not necessarily proving successful recipe. For the situation of reversing back to the more simplified approaches and from the advanced IRB to foundation IRB or standardized approach, there is one single major observation we make, that ECB's expectation is that you try before, if you want to have the intention to move back right away to standardized approach, you might need to explain why foundation IRB might not necessarily be relevant, might not necessarily be working for you. For certain type of exposures, specifically speaking about specialized lending, if and when you want to move from, let's say, foundation IRB or advanced IRB back to standardized approach right away, you might be challenged and you might be asked, why haven't you considered the slotting approach? Maybe that would be more reasonable, more suitable for you, because specialized lending by and large contains a number of transaction features which you can easily cover by the slotting method, which can actually reflect the riskiness of these transactions in a much more granular fashion, might be advantageous for the institute. So basically, you are asked to provide a rational reasoning for your choice why you move back from advanced IRB to slotting or to standardized approach. It requires obviously a level of cost-benefit analysis, a feasibility assessment, and certainly banks have been recommended in certain asset classes and exposure classes to have a certain methodologies and approaches. And that's also one of the reasons why you need to be more careful how to move back to less sophisticated methods without any justification. Submitting a formal request will not necessarily provide you with the relevant positive outcome. And one other important aspect is here, if you are in one asset class, say corporate asset class, significantly undercovered by IRB models, in other words, you've been using permanent partial use, you might need to know as well that the ECB understanding it is that in an asset class, you have to be about 80% at least covered by IRB models. Any lower coverage than that needs to be argued with reasonable points, and it has to be discussed and agreed upon with the joint supervisory team head, as this has been seen for a while as a critical criteria to give the IRB status to any asset class. So one needs to take this seriously into consideration. Your permanent partial use, yes, you can apply asset class level, but then you might need to be limited to something like 20% out of the 100. One other important discussion point had been as well the so-called live production of the rating models at the time of application. At the time of pre-application, already the models should be embedded in the system, which is 3 months before the actual application and before the approval for sure. So in other words, it might make sense that to have a live system in place already when the models are almost delivered or redeveloped. At that time, it might make sense. For many banks, as the core systems have been used to embed the functions, the rating model or scoring model functions, it's a big deal because they don't have a system where they can easily adjust and adapt the scoring function into the core system, and they don't have usually a rating platform, many banks. So it takes them quite a long time to basically create an environment where the new model can run in parallel with the old model. And this is a very important task. Banks who have been delayed on that might be receiving really severe findings at levels of F4 from the ECB teams. And there was a number of clarifications recently about the unlikeliness to pay criteria, their past due counting, a number of consistency related issues related to DoD. So, I mean, banks sometimes receiving in the last year as well some inspections specifically geared towards understanding to what extent they are compliant with the DoD requirements. So if there are significant changes needs to be implemented in matters of DoD policy, then technically this might be easily doable. But on the other hand, that might lead to a different count of defaults. And if that's the case, then it is likely that certainly you might need to redevelop the models because they will change the statistical properties. At segment level, banks need to be calibrating, ideally. I mean, there's no clear indication here whether you need to go for grade level or segment level calibration. However, if you do the segment level calibration, you have to be sure or ensure for, as a matter of fact, that grade level PDs are appropriately also matching with the segment level calibration. Some banks have not necessarily been doing this type of adjustments, and they were unfortunately being tested on this and challenged on this on a number of occasions. So I just like to emphasize that again, if you do the calibration at segment level, you have to make sure that the grade level calibrations are also statistically and mathematically matching. Otherwise, you might be receiving easily an F3 or F4 during the inspections, model inspection. External data might have been as well used for systematic, benchmarking purposes. But again, you need to make sure that your internal default definition and external default definition are on the same level. They are par. If they're not par, they're not on the same level, then you might be as well challenged on that. For many banks, the point of CCF adjustments will become another challenge down the road, because basically any portfolio that has undrawn portion, and given the fact that the asset or the facility is so-called revolving facility, can be easily building a model, conversion value model, CCF model. However, this is clearly constrained only to undrawn credit products, revolving credit products. If the credit product has not a revolving nature, and if there is no legal rights on the hand of the bank to revoke the loan anytime legally, then this might be a questionable choice, because under such cases, the foreseen CCF is the standardized CCFs, in most cases 100%. In the roundtables in November, one important discussion was about weighting the historical data for calibration purposes, especially in the area of retail, in the retail models. Here, one interesting discussion is if you believe that the more recent data is more representative, And if this is the case, then you might want to use the more recent data for calibration purposes. Also, the expectations are there clearly that you need to assess the range of variability as a mix of good and bad years from the historical data. And for that reason, there are two approaches that are available to you right now. One is called the principle-based approach, and the other one is called the reference-based approach. I will discuss this briefly in more detail. But both approaches, whichever you choose, needs to be analyzed and statistically tested, whichever works best for the given model and for the given portfolio. For the realized LGDs, the full time period for which the data is available needs to be used. And for the same reason, if you want to do calculation on downturn LGD level, and for the downturn LGD, the quantification should as well match or even exceed the level of granularity available for the long run average LGD estimation. So in other words, if you want to calculate the downturn LGD and the observation period of yours is about 10 years, so the downturn LGD should be as well calculated across the 10 years period with economic, macroeconomic assessment and sensitivity analysis, obviously. If you're using for LGD estimation, the so-called component approach, an assessment of downturn period at individual component level should be also conducted. And this is clearly one of the challenges banks need to take into serious consideration, because in most cases at component level, such an analysis might be missing based on our own observation on different occasions, on different consultancy engagements where we have been practically supporting the banks across various European territories. What came out to a realization or observation is very clearly that component approach is the preferred approach for LGD modeling in the eyes of ECB. However, the granularity should not only be less than for the whole data that has been used for long run average LGD estimation. So in other words, full time period is relevant here. We already discussed the issue about IRB modeling for the CCF risk parameter. It's limited again to undrawn revolving commitments. Nothing else. Is anything outside of the scope will be treated as 100% CCF. And therefore, I think many banks either need to adjust their product features, especially on the non-retail area, or they need to stop using a model for the capital charge estimation purposes. That has been, again, as we already discussed, been on the agenda for some time. And also here, again, just to reemphasize, we have been mentioning that last year in December, when we had been conducting a similar webinar, the common approach which we used in the past, the cohort analysis, is not anymore acceptable. You have to have a time window of 12 months from the moment of default. So basically, you need to be looking into a different type of modeling approach if your previous approach has been rather conducted in terms of cohort analysis. Yeah, let's discuss in a bit more detailed fashion about the how we assess the range of variability or calibration purposes, which we already called principle-based approach, which is what has been preached by ECB folks. There's an article in CRR 180 2A, and here institutions are mentioned that they are not allowed anymore to weight historical data for model calibration purposes if more recent data is better predictor of loss rates. And this is fortunately or unfortunately the case with certain portfolios at certain moments in time, when the portfolios, especially going through, if they are very sensitive to economic cycle, example being corporate real estate finance, example being project finance, and then you have an avalanche of unforeseen defaults in a short period of time, then another 6-7 years passes without any defaults whatsoever. In such cases, it might be really a good idea to use more recent observation for calibration purposes. Because the long run average, if you use a longer period of observation, more than 10 years, might easily lead to underestimation of upcoming expected defaults. As again, all related to the fact we are not talking here about retail. This is most of the time the case with some non-retail exposure. In the retail area, especially in developed markets, we would not be expecting such volatile behavior, although it might happen once in a while, but then it might be due to a severe economic downturn and crisis, not necessarily a smooth recession as it might be happening right now across Germany and some other Central European markets. Historical observation periods are recommended and must be used at least 5 recent years when we calibrate PDs, and all the data should be incorporated or could be incorporated if it reflects significant variability. The objective is to a large extent to cover a likely range of variability as much as possible. Also, representativeness of good and bad years needs to be weighted out here and assessed. Institutions should evaluate if the historical data includes a mix of good and bad years, that these are justified as bad years by using economic indicators. And this might not necessarily be a scientifically 100% proven track record, but usually the economic indicators have a lag, and this lag is stretching out sometimes from 6 to 9 months, in some cases even 12 months. Therefore, an economic sensitivity analysis based on indicators with time lags is very much what's needed here to justify a call for a given bad year. We will discuss as well in detail what does that means, this sensitivity analysis. It means that we need to develop a simple macroeconomic model to select macro variables which might be indicative for a downturn year. If the analysis show potential absence of bad years in the model, this can be as well in a way quantified in terms of the MOC levels. As we go through time very fast right now, in the hindsight of time, what is the ECB focus in matters of principal approach? Maybe as well, we need briefly summarize. First of all, to understand the correlation that exists between observations, maximum minimum values of the observations, we need to define and document clearly criteria for classifying as good and bad based on economic indicator. That has to be related or relevant. I mean, that in every other portfolio, it's a different one. For retail, it might not necessarily be changing GDP. It might be something else. For non-retail, it might be changing GDP, but doesn't necessarily need to be unemployment rate. And we need to make sure that this analysis is waterproof and can be easily challenged by the inspectors of ECB. We need to ensure the proportion of bad years in the historical period used for calibration purposes exceeds the calculated proportion from the broader economic data set, and verify if maximum observed default rates in the sample in the internal data are included. Then we need to make sure they are included in the historical observation period. Obviously, needless to say, correlation analysis needs to be conducted, and analysis of the relevant external data might be quite useful here, but as some portfolios doesn't give much relief in terms of finding out which would be a bad year. In that case, external data that specifically matches with the exposure types and characteristics of the institution might be critically important, because this is the only way forward probably you can identify anything in that very area. Well, comparison needs to be done between long run average and observed default rates before most of the time, including the MOC. But at calibration level, you need to maybe relying as well on a reference long run average default rate if you choose to go for the reference-based approach, which might be quite relevant. And here, the reference default rate calculation should be based on a fixed period between January 2008 and December 2008, or even 2019. And if internal data are unavailable for the entire period, the bank must infer this using the external data. Justification for the choice of the reference and for the choice of benchmarking criteria obviously need to be brought in. And this is, I think, a fundamental new look in the way how we can estimate the long run default rate to use it for calibration purposes. Here, obviously, the key challenge would be choosing the right benchmark and availability of external data, which is most of the times, unfortunately, quite dependent on heavy subscription fees if you want to go for external data providers, which is what we do in most cases, what we should be doing in most cases. And there's a sincere recommendation from PwC, one team Frankfurt, and I think one team Portugal, use not one external data provider, use at least two, because they need to be cross-checked at all times. Not for all portfolios, all providers give you the same quality and granularity of relevant data. Luis?
Yes, Cam. So evolving on the topic, so basically, we can go for the LGDs. So in this regard, let me just shift the slide. So main developments here from the ECB side. So there is clearly here a concern that the calculation of the realized LGD and the overall average, they really capture the full time period for which data is available. And that's an important topic. So that you cannot somehow delimit the data that is available. And that's one of the concerns that ECB really spot in the industry feedback. And also in terms of the final calibration, these are not particularly something new because it was already on the EBA guidelines on PD and LGD estimation. But I see these as a sort of alerts or advices from the ECB so that we never forget that we should consider all incomplete recoveries. That's something that is relevant because it's typically the case is that most often you may see higher losses or lower recovery levels. And also to do the alignment between the long run average and what is, calculated at segment level. So basically, so that we can ensure that there is no average that indeed has been captured the full data that is available for each of the segments for use for calibration. Another 2 or 3 topics here that are mostly driven by CRR3 development. So one of them is basically that you should calculate the realized LGD at single facility level for each default. This is not something new, but the ECB alerted for the importance of never forgetting these specific requirements. And the 2 main changes that I will here like to stress is one is the extension of the application scope of Article 500, so related with massive disposals of NPEs, which we all know that it was limited until June 2022, and now it could have been extended or maybe extended to 2024. We know the requirements are limited to what are your plans regarding massive disposals, their agreement with your national competent authority. But basically, we have here more or less an extension of 2 years and a half of situations where indeed the losses that are linked to this kind of disposals may not be unduly influencing, in this case, negatively, what is the overall losses that are quantified. The other requirement here that is being highlighted by the ECB, because this is a change from the CRR3, is that no longer you can do a kind of weighting of your historical data, even if you think that recent data is a better predictor of your losses. And that implies that from a quantification perspective, you need to remove all kind of weighting approach that probably you have been developing in the last years. Okay. Downturn has indeed been I will say that half of the concern of DCE overall, because many of the additional notes that were provided here basically focus on the downturn. One of them is the granularity to which you determine the downturn. So it should match the granularity level that was used for the calibration of the long run average LGD. So at least this match should occur. So do not do it on a more aggregated level. And also in terms of the calibration, the ECB is here again highlighting that you should look to all the effects that should lead you to the identification of the downturn period. It recalls this paragraph 27 from the EBA guidelines 1903, where indeed you should match the downturn period with situations where your defaults take longer to recover, where the situations of defaults that are cured tend to be lower, where losses tend to be higher, and indeed your recoveries are not so evident. So all these dimensions should indeed be linked to the identification of the downturn period. Another points that are here being highlighted by the ECB is the fact that you should assess the downturn impact at each level of the or each component of the LGD. So individually, you should do this assessment, and overall, when you aggregate all the components or all the dimensions, you should at least reflect the component that has a higher impact. So basically, when you do this aggregating, at least you should capture the highest impact overall that may be influenced by one or two components, but overall, this should be the more preeminent effect being here captured. And in this regard, overall, it should reflect what is expected to be the most elevated average realized LGD levels during a downturn. And that's basically what banks are here required to do. It's not specifically new, but the fact that overall these more negative effects should be indeed signaled and be clear on your final downturn LGDs at calibration level. This is the main concern that ECB indeed is shown here. Again, the ECB brings the reference value. The reference value was somehow already used through the TRIM missions. It was part of the ECB handbook, but basically here we see a clear, I'll say, a clear view regarding how indeed it should be applied. And basically what ECB is stating is that institutions should compare the reference value for the final downturn with their downturn LGD estimates, basically identified in the two worst years. And that's a very important point here, because these 2 years will be indeed the basis for the calculation of this reference value. Okay. So in case you have any kind of material differences where you need to identify what were the root causes, and in some of the cases, you are most advised to try to fill the gaps with additional conservatives. But basically, when calculating this reference value, you should use all available information that you have in your reference data set. You should identify these 2 individual years with the highest observed economic loss, and again, at the level of the calibration segment. For these 2 selected years, you need to do this default weight average realized LGD, and then it's the average over the 2 yearly averages that will determine this reference value. And again, per calibration segment, you should confirm or that your reference value is indeed being observed. So at least your final downturn LGDs, they match, or at least they are more conservative than this reference value. If indeed you have the different realities, so indeed your reference value tend to be more harsh, that's where you need to deep dive and try to understand what could be the possible justifications. But as you all know, in this situation, it will be much more difficult for you to support your final downturn LGD values. Okay, so moving to the CCF parameter, because basically, as we all know, CR3 brings, as Kaan was also explaining, some additional requirements, which will be most impactful in many situations. So basically, the scope of modeling is now completely redesigned. Basically, it tends to be much more limited only to undrawn revolving commitments, assuming that you don't have also a 100% CCF being applied under the standardized approach. But basically, this delimitation to undrawn revolving commitments in many banks is leading to more or less a reduction. It could be varying between 30-40% of the current scope of balance sheet exposures that are currently or were until the end of 2024 subject to CCF on estimations. Okay, and that's a very important point here. On the other hand, we no longer have IRB Foundation CCF, so we only have indeed two realities: on estimates or standardized approach CCFs. And these standardized approach CCFs shall need to be applied to exposures to institutions, financial sector entities, and to those large corporates that have the meaning of large corporates whose annual turnover at consolidated level is exceeding 500 million euros of annual turnover. Okay, moving on to another point which is here relevant is the concept of commitment. So we have a more detailed definition of indeed what is a commitment. We know that this definition on the standardized approach could be even more complex, because under the standardized approach, it is clear that you may also consider any kind of pre-approved exposure. So you don't need to have already the okay from the client. As soon as from your side, the approval process is done, it's already considered as a commitment. When we try to bring in this concept also into the IRB space, it is a little bit strange that you may recognize as observations exposures that indeed they are not yet active, in the sense that the client didn't say any kind of okay. If you bring those exposures or potential exposures into reference data set, you are bringing only noise, because none of them will default. So the CCF calculation will never be in place. So basically, it's only on the application side, not so much for development or calibration. Okay, another message here is the application of input floor. So as you all know, it's always linked to what is the CCF applied for the standardized approach. Other topics here on the calculation of the realized CCF. So there are no caps when you calculate individually the CCF for each observations that you have a reference data set. It was already in the same way in the past, but that's a very important message that ECB wanted to stress here. So you, at least in terms of the quantification, that should not be allowed. Another thing could be, for instance, when you are using only for in the development of the model per se, but not on the calibration, not on the quantification. Another important change that is here being stressed is the fact that the application of the 12 months fixed horizon is something that is now inevitable. So all other alternatives that we have seen in the last 20, 25 years being applied shall not be available. And when you fix in these 12 months horizon, you may have changes in the customer portfolio mix. And basically what ECB here is signaling is basically try to understand if indeed your CCFs could be unduly influenced by the change on the product mix. If that is the case, you need to analyze what were the causes and basically try to see if extra conservatism should be embedded in your quantification process. So this new change in terms of the fixing the 12 months also has a kind of externality that needs to be properly assessed also here in the quantification process. Another topics that are not directly linked to the risk parameters, but we should not misconsider here. One of them, Kaan has already said, so we have no longer any kind of minimum coverage or maximum expected coverage at portfolio level or balance sheet level. What we'll have is at exposure level. Here the ECB stated that the 50% overall of the entire balance sheet will no longer be valid. Basically, it's a kind of removing this coverage ratio. It stated that at exposure level, it won't fix any kind of minimum coverage. But as Kaan was saying, what we see many discussions that are taking place at GST level or even in terms of inspections is that the 20% maximum of not coverage will be somehow the guiding principle. So it's not binding in the sense it is formal, but it will be taken as a consideration in the assessing that at exposure level. And exposure level, we need to look at the interpretation of Article 147, because that's where we have listed all the type of exposure levels that are recognized as such under the CR3. So basically, it includes the different exposure classes. Within corporate and retail, we have an extra segmentation layer. So depending on the nature of the exposures, and this 80% will be the reference that will be used by DCB. Again, is most of all, it has been shared informally with banks. Last but not least, a very important point is you need to have an overall or a group-wide strategy for what will be the perimeter and the rollout plan for this new IRB scope. And it has to be anchored on formalized, objective, and more intuitive or properly explained criteria to define exactly what will be your perimeter over time. In terms of definition of default, and that's a very important topic because, as we all know, it was highly discussed since 2016 and probably until the end of the TRIM. A lot of discussions took place on the effective implementation of the same definition of default. What here the ECB is signaling is that the quantification of the 90 days past due should include, in counting what is the material exposure, all kind of overdue principles, and here including payments on other financial products. So we'll try to understand in the next months is indeed what is meant to be here captured in addition to what we have today. Another concern from DCB is the unlikeliness to pay indicators. So try to bring in other indicators that could be more reflective of very specific characteristics of exposure types. So basically try to do a deep dive assessment and try to bring the idiosyncrasies that probably certain exposures may have. One of the examples is asset-based lending exposures, where the value and the marketability of the assets that were financed, it could be a very important indicator, and basically it should be analyzed how it could be brought into the set of UTP indicators. Last but not least, in terms of the validation, so the ECB signaled, as we all would be expecting, that the handbook of validation of IRB systems that was published by EBA will be fully applied. So the ECB is also interpreting what are the expectations from the ECB, from the EBA. The validation procedures should be aligned with the materiality and the complexity of rating systems. So there is a clear concern for the ECB to drive the path for the future. So again, refocusing on what is material, what is complex, and again, recovering what is a very important topic on the full validations exercise. So in many cases, full validations were determined because you were submitting a model change application. And basically that was the expectation. For the ongoing life of IRB models, you need to define that at least every 3 years, what are the material rating systems that need to be subject to a full validation. Last but not least, again, the focus on internal control functions and their role in terms of keeping the IRB models in good shape. It needs to be clearly documented so that everybody knows exactly what needs to be done. As you know, this is a very subjective matter because typically we are never reaching the expected level, but at least this focus on documentation is a very important point. So before closing the list of the main topics that for sure we shall be discussing and analyzing in the next months and years, I would like to signal that EBA has a mandate for almost 20 new documents. 9 of them will be referenced at RTS, it will be regulatory technical standards that we know that typically the legislative process is slower in the sense that it needs to be approved and published in official journals. So it's not 100% dependent on EBA action. But as you can see here, we have multiple topics being discussed in the next months. So until July this year, we should have the new guidelines on the definition of default, precisely focusing on the diminished financial obligations. This is a very important aspect whenever you do a restructuring in a client facing financial difficulties, you need to understand indeed if there is a diminished financial obligation. If that is the case, you should flag that that facility or the client overall as being default. So by summertime, we should have news here from DBA. There are also other documents that I would like to highlight. So by the end of this year, we should have the guidelines on artificial cash flow and discount rate. This is particularly relevant for LGDs, because if EBA changes the current discount rate that is being applied or how the artificial cash flow should be computed, we'll need to redevelop our LGD models. And that's a very important point here to highlight. Specialized lending will be at the heart of concern from EBA. So we have here at least a couple RTSs here on very specific topics. We'll have a revised assessment methodology RTS, so for IRB. It's a document that is applicable to NCAs, but of course it's also relevant for banks. And we have a document on, it will be an RTS on estimating PDs that will be published by July 2026. So it's something that will complement EBA guidelines on PD estimation, because it's exactly what is meant here to be brought, and it is mandated by the CR3. So another issues here being covered. So as Kaan was saying, we shall have new guidelines on estimating IRB CCFs. So by the end of 2026. And to be honest, ECB, is also signaling to banks in the same way as EBA did on July last year in terms of what are their expectations regarding banks now redeveloping their CCF models. Basically, there are a lot of changes that need to be considered, and probably you should package all of them so that you can have a single model application for a model change. And the end of 2026 will be very important here, so that you know exactly overall what will be revised expectations on modeling CCFs. On the rest, so exposure classes assignment, integrity of the rating assignment process, and also credit risk mitigation will also be under revision of the standards. And without further delays, I will hand over the word to Peter. Please, Peter.
Thanks a lot, Luis. First of all, colleagues, can you hear me? Okay, perfect. Then do I share the slides from my screen, I suppose, then, right?
Yeah, you have already the rights, Peter, so you can...
You can use the arrows, Piotr. You don't need that. Yeah. You have the ball. You can do that.
Yeah, page down.
Okay, but I don't see the slides anymore on the screen.
What have you? Okay.
I see I see our faces.
Change the layout, Piotr.
Yeah, we can move the slides for you if that is the case.
Okay, you have the first slide now, Piotr.
Yeah.
Okay. So everyone, you see the slides on the screen,
yes,
right?
We are seeing the slides.
Okay.
Yeah.
Except you.
Okay, perfect. Thank you, colleagues. Then maybe just a 30 seconds introduction. My name is Peter Geraskin. I work in PwC Germany, team of Kaan Aksel, and I focus on credit risk modeling topics. And in the last couple of years, AI is becoming more and more relevant. There is both interest on the bank side in incorporating AI methods, and as well as there is an interest from the regulators, and they provide more and more documents on this topic. So first of all, perfect, now I also see the slides. So first of all, as Kaan and Luis mentioned previously, there was an ECB roundtable on the credit risk topics last year, but as well there was an ECB roundtable on the machine learning techniques which could be used for IRB models, and that's the topic which we wanted to discuss with you today. Basically, What is the motivation, first of all, to use machine learning for IRB and in general for credit risk models? Well, there are several motivations. First of all, in the regime of high interest rates, the better you can discriminate or distinguish between risk, the better you can do your pricing and the more competitive you can be. Therefore, machine learning models, they are maybe not so helpful for the banks when we live in low interest rate world, but they are much more helpful when we live in high interest rate world. Therefore, in the recent years, there was more and more interest on these topics. Secondly, what we clearly see is that if we improve the discriminatory power of the models, like PD models, for example, due to the structure of risk-weighted assets formula, it can release certain risk-weighted assets. And of course, one can argue, how does it work in the current world when we have an output floor? And it is still relevant because now there will be portfolios which will be the so-called risk acceptors and risk donors, and the distribution between capital between these portfolios is one of the topics on which currently banks are working on, which portfolios, because of the output floor, will be providing capitals to other portfolios. And one other reason, which is not that much often discussed, but which we see is very relevant, being able to use machine learning approaches even partially in the models extremely boosts the motivation of the teams. So if we want to keep teams motivated, then giving them an opportunity even just to develop a challenger model in parallel with the existing model, that's really helpful. Now, of course, when there is interest in machine learning by the banks, there is also interest in this topic by regulators. And what we see is that, first of all, EBA has published some time ago a discussion paper on machine learning in IRB and then published a follow-up report on this. And then last year, there was a roundtable of ECB on this topic, and the conclusion of it is that this year ECB is expected to publish the updated version of ECB Guide to Internal Models, which will include their expectations or requirements on usage of machine learning. So what are the main topics in this regard? I would say they could be split into more qualitative and more quantitative topics. When we speak about qualitative aspects, then of course ECB expects a significant increase in terms of skills and expertise of the teams. All stakeholders, including also senior stakeholders, need to understand how machine learning works, need to understand what is explainability and what are the risks associated with these models. Then banks should very clearly track what is a model change, because in machine learning models we have a very complex intersection between risk drivers and hyperparameters. So we need to very clearly define what is material model change, what is non-material model change. Is change in hyperparameters, is it a material model change similar to changes of risk drivers or not? Then, of course, banks have to strengthen their internal control functions, including validation, including internal audit. And of course, if we use, we have to use a more complex data, and we have to have much better controls over our data, because garbage in, garbage out principle applies even more for machine learning models. And when we use data for from outsourcing, that's even more complicated. Maybe now let's zoom into other topics. Let's go to the next slide. Yes, so when we speak about the model development, it's really important that we analyze biases much more detail in our training and calibration data. When we compare machine learning model versus classical approaches like logistic regression, for example, then the weight or the coefficient in logistic regression represents the intuition, or is basically explainable and shows what is the sign of the dependence between explanatory variable and target variable, and how strong it is. Now, the problem with machine learning models is that it really depends depending on which section of our data set we're speaking about. So we have seen multiple times in machine learning models that certain segments of our development data could be biased. So we have seen, for example, certain biases for old versus young customers, or the biases related to gender, and this has to be analyzed in detail. Then model update frequency is really important. So it has to be really defined what kind of model updates we have. Do we have updates of the data sets? Do we have updates of the risk driver scope? Do we have updates of hyperparameters? And that has to be really clearly documented. And in each case, there has to be impact quantified on risk-weighted assets, on expected loss, and on capital ratio. Let's move to the next slide. Yes, so explainability is the central concept behind all this framework, and we will zoom into explainability in much more details in the moment. But basically, the background is that we cannot compare the explainability of machine learning models as easily as we do it for logistic or linear regressions. We have to assess individual risk drivers depending on the segment of the portfolio which we're looking into, and we have to assess the overall model explainability and whether it makes sense. Of course, we also have to be very careful with human overrides, because the override policy could be related, could be connected with negative correlation depending on number of input variables. So when we apply human overrides on top of our machine learning, that could lead to even more problems in our model. So having said that, it's really important that we build a very strong model risk management and validation frameworks. And on the next slide, you can see the example overall model risk management framework for the AI models. It includes multiple components, starting from data structure, going to model architecture, of course, model testing, on which we will focus in more details, including also ethics, controlling, and processes. At each of these steps, the model structure has to be checked. So, for example, if we speak about model architecture, it's important to clearly understand which algorithm we're using and why we're using it. Does it bring significant value add-on compared to classical approaches such as logistic regression? When we speak about processes, we also have to very clearly ensure that our processes in terms of data collection, model construction, model testing, and model use are properly constructed, are properly overseen, and do not lead to potential risk of model non-performance or underestimation. If we zoom into the model testing part, and that's what our quant team, so to say, main bread and butter is, here there are, of course, all the classical dimensions which we're usually doing for as part of model testing or model validation, including calibration accuracy, including discriminatory power, and so on and so forth. But there are two very important groups of aspects which are very specific to the machine learning model. This includes explainability, and this includes additional performance tests. And now, yes, let's zoom on this slide and discuss what are these metrics. So first of all, it's really crucial that we assess importance of our variables. In classical models, it's really easy to compare importance of variables depending on the coefficients or weights in the regression. In machine learning approaches, we have to use a more complex methods such as Shapley ratios or Ellie ratios, and so on and so forth. And for each variable, we have to assess it, and we have to assess it not only overall, but also depending on which region within our data set we are in, because one variable can be really important and play a crucial role for old customers, but play almost no role for young customers, and we should be able to explain it and document it in our model documentation. Then, of course, business context is really important, so this analysis has to be discussed and aligned with the business stakeholder. Does it make sense that we use certain variables and they follow a certain dynamics for a particular group of customers, or maybe we cannot see that they are really so crucial, and then it would make sense to simplify the model. So the general idea of supervisor is that we should make model more complex only when we really see value added in it, either in terms of our discriminatory power growth or in terms of improvement in calibration accuracy. But we should not make model more complex just for the sake of having fun of working with the complex machine learning methods. Then, of course, reliability of the model is important. This comes down to the global interpretation. So we should look into how the model overall behaves on different segments of our customers, old, young, small, SME, large SME, and so on and so forth. Of course, also robustness is important here in terms of stability of explanations and changes in explanations in relations to changes in input. So you can think about it as a small stress testing or simulation analysis when you change the input and you see, okay, does my model work well if I move a bit out of my initial application scope? And those are the areas which correspond to explainability. Now, another important group of areas are related to performance. Why it is important to conduct additional tests related to performance? Because machine learning models are much more subject to overfitting. And here, of course, we often have in machine learning approaches more hyperparameters, which means that we have more areas which we have to test. And one really important point here, which supervisor asks us to do, is to compare with linear or classical models, which are logistic regression or linear regression in case if we use it, and see if we really have a value added based on machine learning models. And if not, then maybe we should stick to our classical models. Now, on the next slide, you can see the overall comparison of different models. Basically, currently, we can start with the classical logistic regression models and go to very complex neural networks models. What we see in practice, the best trade-off is around gradient boosting. These are also the models which are currently winning credit scoring competitions on Kaggle. In case if you are interested in machine learning models, then most certainly you have seen on Kaggle those ratings. And in general, both from a competitive perspective as well as at our clients, we see that gradient boosting seems to be the best trade-off between model complexity and improvement in terms of model performance. Now, I would say that is a very short summary of the machine learning topics. If you have any questions, and if we don't have time to answer these questions right now, then please feel free to reach out to me via email or via LinkedIn, and I would be super happy to discuss these topics. These are, I think, the topics which are currently still very much in the development phase, and I think it really makes sense that we as industry, we make it develop in the right direction so that it's helpful to really assess performance of the models and not just to tick the boxes which might not represent the model quality. Thank you for your time.
Yeah.
Then
Thanks a lot, Peter. I think it's the time right now for the questions and for the Q&A session. We got 3 questions, and just before we address this, maybe one important information would be we will have a second webinar likely early April or late March. We will announce that as usual through the well-known channels. And I think this webinar will be more focusing on ESG and on some other subtle issues around the risk parameter estimation, especially CCF, but we will announce it in time. There is one of the questions is related to the permanent partial use percentage-wise, where did that come from? The reality is this: in 2018, the ECB has prepared a TRIM guideline for the banks, which would be indeed going through the TRIM inspections for their IRB models. And in that guideline, the understanding was that 80% of an asset class had to be covered by an IRB model to be qualified. IRB having the IRB compliance on that asset class level. As this is under the CRR3 going forward. Can I have the ball, Luis, if you don't mind? It would be absolutely relevant related to CRR3, because at the end of the day, the CRR3 is stipulating not anymore the use of so-called balance sheet coverage ratio. And we are right now in a business of only covering asset class. So bank can easily be on standardized approach on all portfolios, maybe except one, in one asset class. So basically, this is the topic which is really relevant right now. And banks are asking the regulator to move back to standardized approach, because the threshold that is introduced according to CRR3 doesn't necessarily leave them a lot of room for improving their so-called capital requirement ratio. So in that sense, they make the judgment and they want to move back to standardized approach. And in other areas, they might not be able to meet the minimum requirements related to advanced IRB or foundation IRB. In that sense, they want to move back as well to standardized approach. But if they do so, they need to still bear in mind that in that asset class, the idea or the thought that the ECB folks have in their minds is 80%, around 80%. Could be a bit more, a bit less, but not significantly less than that for sure. That has been coming to our attention on different occasions, on multiple occasions. One other
just last point on the question that was raised. Specialized lending is considered to be one of the asset classes. It's a sub-asset class part of the corporate. So the minimum coverage should be applied at that very specific type of exposures. Okay, just to complement on the question. Yeah, please.
Yeah, and the second question, I think it's a very, again, important question. The second question that we received is about PD calibration at segment level. The question is, do you expect that the calibration has to be appropriate on sub-module level or entire portfolio rating system? Definitely not entire portfolio rating system. If we're talking about the segment level, a segment is might have sub-segments. At sub-segment level, obviously calibration needs to be adjusted accordingly. Example, you have a large corporate portfolio and the portfolio is mostly about the European counterparts and corporates. But then another portion of the investment is related to some, let's say, third world countries in Africa or some other continents, right? In that case, obviously, you need to have either a different factor in the model that captures the geographical differences and riskiness, or you can solve the issue by creating a sub-segment level calibration. It is the expectation of ECB that you do come with a solution in this respect, either using the first approach that I described, having a different geographical factor in the model, or a different level of calibration. Obviously, one calibration segment might have different subsegments, and all different subsegments cannot necessarily be covered by just one parameter in place. Luis, you want to add here something?
Yeah, it is a very specific point. So what we are seeing now, especially in portfolios that are more biased to low default portfolios, so that the minimum number of risk grades or PD levels of 7 that is stated in the CRR, what we are seeing in several banks is that this requirement has to be met at rating system level. So basically, you may have models that indeed are not meeting these 7 risk rates, but overall the rating system has to do it. But on the rest, I mean, I fully agree with what Kaan mentioned. So it's really need to be focused at model level. Sure.
And maybe one point there to add is very important. Many banks are using a scale, but we sometimes as well call a master scale. And the master scales that the banks are using could be completely related to internal reporting purposes. Okay. But essentially, if you have in or one or two rating grades a heavy concentration, this would be perceived to be a lack of discrimination power in the eyes of ECB. So, to make the long story short, if you are using a master scale, please make sure that the master scale has not been predominantly crowded in one or two rating grades, but it dispersed more or less smoothly and decently across most of the rating grades. And master scales cannot be just put together by putting boundaries on a continuous PD curve. You need to adhere to the master scale we call configuration requirements, which means every midpoint of every bucket has to have the same distance from the next bucket's midpoint in natural log terms. It has to be following a linear natural log term line with an intercept and a certain curvature, and this would need to be corresponding to the rating models, usually, which is the large corporate rating model. Most banks has to be starting with that. And in that sense, I think it's very important that you take it seriously, because regulators, most of the ECB folks will look into that. And if you want to have a continuous PD level estimation without a master scale, as far as the ECB goes, I think this is completely fine. But then you don't never need to create a scale for internal or external reporting purposes, because this will, in that case, will be taken under the loop of consideration and inspection. Please be aware of that. There is one more question, Lucia. I think you need to answer that. It's about slide number 27. The question is, hold on a sec.
No, there is another one before that.
Yeah. Your
write-offs. Yeah, right. So how are write-offs used in the calculation of LGD? So,
no, I was referring to the validation frequency question. That's also a question that I think Piotr can answer, but you might want to answer the validation frequency question.
From a regulatory perspective, for non-mature models, it will be expected that at least you have a kind of a light validation in place, which will match most of what we see regarding a monitoring exercise. So it will be anchored on the validation framework. It will be a light exercise. So I wouldn't be expect banks to indeed not carry out any kind of challenge on model performance on a regular basis. So for IRB models, I have doubts that in the upcoming years that will be acceptable. But as you all know, a lot of major movements have been done in the market in terms of automation, standardization of the metrics and the tests. I know that there is always the issue regarding updating reference data sets for the validation exercises. So it's always a tricky exercise depending on how the different systems are set up and all the procedures that are internally developed. But basically, a light validation always has to exist to make evidence that the models are performing as defined by the different quality thresholds. Okay, Petr, I'm not sure if you want to add anything here.
Yeah, maybe I can just add quickly. So when I suppose this question was specifically related to machine learning models. So here it's not the question if ECB might accept that we make validation less frequently. It could be other way around. So what we have seen, for example, when we develop challenger models based on gradient boosting is that its discriminatory power or calibration accuracy can deteriorate like on a half a yearly basis quite significantly. And what could happen is that if you are going to use machine learning models, then you might be requested to make validation more frequently if you can't show that the model works stable enough to continue with yearly validation.
Okay. And I think the other question was on the
about the validation frequency with model risk. Especially, I think this is your area of specific interest.
Yeah, I think the question was answered, right? So
Yes, partially. One of the questions just received, I think this is for me, about the ECB communication and publication on using rating master scale. There is no such requirement in place, that no detailed explanation in place. ECB has, I should say had, in the last 3 years, the view that a master scale could be happening for each and every asset class. So in other words, you might want to have one master scale for large corporates and for corporate asset class, and you might have a different one for retail, or you might want have it even for the one asset class like corporates, 2-3 different scales for non-bank financial institutions, for financial institutions, or for large corporates. This is all nice and well, but the problem with that is it creates a lot of issues with so-called internal mapping. Then you need to have the job. There's a requirement there that you need to have a decent understanding what that means across the whole portfolios, and it will bring a lot of confusion. And for that reason, probably there are some of the reasons that I might not think of right now, but for that very reason, many banks in the recent years preferably moved to continuous PD estimates without any reliance on any master scale. There are, one of the reasons maybe, which is the master scales need to be verified and they have to be tested. And every second year, the boundary conditions of master scales are changing from a statistical perspective, because they do pretty much depend as well on the number of accountable observations. And in certain grades, the observations are small. The statistical significance might be questionable, and that might be challenged as well. So in order to avoid all this situation, what several banks have been doing is they're just moving away from the concept of master scale, and they're just using the continuous PD estimate as the final solution, which actually is quite easy, quite reasonable. But then when it comes to reporting purposes, internally, they might want to report the concentration risk and things like that. And there they might want to rely on master scale. And some banks never thought that this is going to be an issue for them. But then when the internal model inspection teams arrive, they want to see if the concentrations have been somehow reflected on the master scale level. And then they look into what has been observed the last couple of years, if the bank has never been really adjusting the boundary conditions of the grades. And then in that case, they might have really a very strong dominant crowding effect in certain grades, and that might lead to some serious findings. So if you want to use a master scale for any purposes, for Pillar 2 purposes or for Pillar 1 purposes, please bear this into account, that it is a milk product. You need to keep an eye on it all the time and use it, and make sure that the boundary conditions are adjusted and verified. If not, it might be surprisingly troublesome for you down the road. I think there's a question about the write-offs. I don't know. I think both Piotr and Lush, you both guys can take this into your hand.
I mean, very, very easily. So the EBA guidelines on PD and LGD estimation, they state that, you should consider the amount that was written off partially, which is the focus of the question, as part of the economic loss. And when you look to the total exposure, it should be the full amount before the partial write-off. What we also have been seeing, several banks that have a more or less established policy in terms of partial write-offs is basically to consider such information in the way you calibrate your best estimate of expected loss, or even on your LGD in default. So basically, use that information in terms of how you segment for the calibration purposes. But in terms of the calculation of the LGD per facility, you should consider the amount that has been partially written off as part of the loss. Okay.
Yes, and I can add to that. As Lush said, we certainly take into account as part of economic loss. And also we have seen in a couple of banks which use component approaches. So the baseline component approach is that LGD risk differentiation function is cure probability multiplied by loss given cure plus 1 minus cure probability multiplied by loss given liquidation. So in a couple of banks, we have seen that they also have a third component in this probabilistic formula, which is loss given write-off multiplied by probability of write-off. It's quite rare on the market, but we have seen it a couple of times. So by this approach, you can also, if you wish, take into account write-off in risk differentiation function.
There's another question. I think, Piotr, this is definitely for you. The question is it correct that the backtesting in the validation exercise has to be done with PDs calculated with or without MOC?
Yes, so the baseline, you certainly have to perform tests on calibration accuracy or backtesting without MOC, and overall per rating grade or per calibration segment, you should be fine with your tests, or the tests should be passed without MOC. But also in our experience, many banks do also this test together with MOC just to see how much MOC adds on top of the initial PD, and if there are certain rating grades or certain subsegments on which we do the tests and we fail the results without MOC, then if we pass with MOC, helps sometimes during the negotiations with the regulator. So baseline without MOC, but also a good thing to have it with MOC as an additional support during the discussions with the regulatory authorities.
Yeah. And also, we have received a couple more questions about the ESG topic. But as I mentioned earlier, this topic we will lay out by our next webinar in full detail, and we will discuss this in full length. And so I'm not going to answer this right now, or I don't think we should address that, but I think it will become more and more important. And we are currently quite concerned with the developments in US, because the regulatory environment has been there quite challenged right now, and some key assumptions that the Americans or the Federal Reserve or the other regulator in America taking the responsibility to address the ESG issue might be a bit presumptuous right now, because they might turn out to be they might move into a different direction. So we are actually posed right now to see how in that market the ESG topic is going to be furthermore regulated, and they will have obviously some repercussions for the rest of the globe. And I think we will discuss this and other topics that I mentioned earlier in full detail on our next webinar session in the coming month or early April. And thanks a lot for dialing in today. It was a pleasure to have you. I don't think we have any more questions. And should you have any, you have our coordinates in the second slide. The slides will be shared with you in the next couple of days, and they will be also posted on LinkedIn. The recording would be as well posted, but we will see how to handle that. But again, we appreciate your interest, your attention. More than 220 people have been dialing earlier, and we look forward to see again our next webinar sessions on interesting and new world of IRB.
Thank you very much. Bye-bye.
Bye-bye.
Thank you. Bye.